people recalibrate. When you start getting money, your expenses start going up. If you were comfortable moving around in a Maruti, now you want a BMW or a Mercedes or a Rolls Royce or whatever it is, it's endless. So if you keep recalibrating, you're never going to have enough. Well, we, as I mentioned, are quant traders, so there is nobody who forms an opinion. So whatever opinion I express is what I would call, dinner cocktail conversation. Everybody is an expert, but I am no better than anybody else in making these predictions about where the markets would go. So the best thing you can do is do a systematic investment plan. When your savings are available, invest them in a way that is appropriate for your risk tolerance, for your aptitude, for your financial situation. For an average person who's investing over 40 years of their working life, let's say, that means your money is going to be 16 times if you were to invest in equities versus fixed income. That's the multiplier, that's the wealth creator that you have to tap into if you want to be financially independent.
How should someone even go about equity investing? Let's say I'm someone in the 40s. I know that I need to put in money into the equity markets. How should I start thinking about it? Hello, and welcome to another episode of Desi Fire podcast. Today we have Sandeep Tyagi with us, who is the chairman at ST Capital. Prior to that, he used to run Inductus, which was acquired by EXL. Even before that, which is where I would like to start today's conversation, he is an IIT Delhi graduate, computer science, and that too from the 80s. The first thing that I would want to know is because what was JEE prep like in the 80s? Because I've been in the edtech sector long enough, but I have absolutely no idea how it worked back then.
Well, I think it was still quite rigorous. People used to spend a lot of time, but it was not nearly as crazy as it has gotten in last 10, 20 years. I remember I was in a boarding school, DAV Chandigarh, and I showed up there at the beginning of 12th, I guess in July or August, whenever the session started. And there was this buzz that you have to prepare for IIT, that's the big exam. And I went for my first class, and there were sections based on the marks that you had gotten in 10th and 11th. So I was in one of their top sections. And as we went to the first class, there were very few people in the class in college. And when I asked them what's going on, they said, well, a lot of them are just preparing and they come for some of the classes, not all. And they had, many of them had covered 3/4 of the textbook already. Of course, there were Agarwal classes, which were famous for providing these small booklets that you used to get prepared. There was brilliant tutorials, which used to send a question bank of 2,000 questions that you were supposed to go through to get ready for the exam. So that was a bit of a shock because I hadn't started preparing till I started 12th grade at all. So I had to do a lot of catch up. And that was a wake-up call. And I think I was still struggling to catch up till about January when they used to do a mock test. But it turned out okay. I think wake-up call was sufficient to motivate and put in 7-8 months of real strong, consistent effort. And at that time, that used to be sufficient to make it happen. I think today that would be nearly impossible because people put in a lot more effort to get through these exams.
But it depends because, to be really honest, I hear folks start preparing from class 7th, 8th these days. So yes, times have changed, but you did not do just okay. You did really, really well. Assuming that computer science would be the top branch even in the 80s and IIT Delhi would be probably the top IIT at that point of time. So you did more than okay. What was your rank like?
Yeah, well, this is an indication of how important it was because I do remember my rank from nearly 40 years ago. My rank was 67th in the JEE at that time.
Yeah, so
It
fair
used to
enough.
be a
Even
big deal.
today,
Everybody would ask, "What's your Hava in the
Hava,
ragging
yeah.
times?" And of course, that was deeply rooted in your memory and what you had been able to achieve.
No, even today, JEE rank 67 would probably choose IIT Delhi computer science. So many things might have changed in the last, I would say, 40-ish years, but this is something which hasn't really changed. And after that, you went for an MBA, I think in the mid 90s. I don't know that many people who used to go for an MBA abroad in the mid 90s because it used to be really, really expensive. How did you decide to go for an MBA, and that too, an MBA at Columbia, which Columbia as a business school is a really great choice. I don't think anyone in the world can question that. But from a cost perspective, it would have been a little difficult.
Yeah. So the way it worked out was there used to be at that time only one job that used to pay $1 salary on IIT Delhi campus. That used to be with a company called Schlumberger, which was an oil company. So since I was kind of clear that I wanted to travel the world and have an opportunity to earn on international setup, I applied for that job. It was difficult to convince them because most comp science people used to apply, and if they got selected they still would choose to go to US to do their masters because they would get scholarships. So it was difficult to convince them that I wouldn't do that. Fortunately, they believed me when I told them, and that I hadn't even applied for masters at that program at that time. So I worked in Schlumberger, got a US dollar salary, was able to generate enough savings in about 2.5 years of working that I could go. I also got married about that time, and my wife insisted that I had to figure out something urgently because she was tired of Schlumberger's lifestyle, which involved traveling to offshore locations or be gone for long durations of time. So in October of 92, we decided that we'll go to do an MBA. And Columbia was the only top 10 or 5 universities which used to have an MBA program starting in January. So even though I did fill out applications for 2, 3 business schools, I only sent to one, which was Columbia, and I was fortunate enough to get in. So I was able to start in January the business school program and didn't have to wait a whole year. So that's how I ended up going to Columbia. That's how I ended up saving enough to be able to pay for it because I had a dollar salary job right out of college.
That's inspirational enough, to be really honest, because people can't even save for an Indian MBA on an Indian salary these days. Some of the freshers, as you would know, get hired at 20-25 lakhs per annum. It's a pretty, I'm not saying everyone gets it, but let's say you can expect an IIT Delhi computer science student to probably get a 25 lakh rupee salary. But not a lot of them are able to save the amount of money which would probably be needed for an MBA a couple of years down the line. I know that because I used to teach MBA aspirants, and cost of education used to be a big factor, even for those who had fairly good salaries. Really inspiring that, the saving thing comes from there. Other part which I read about was the Inductus acquisition, which happened around 20 odd years ago. We do read about startups getting acquired, fairly frequently these days. I don't think it used to be that popular of a phenomena 20 years ago. Could you tell us a little bit about how the entire acquisition thing worked out? I saw a few news reports which talked about a wide range of $20 million to a $40 million acquisition at that point of time. That's 20 years ago.
Yeah, yeah. No, it was a cash and a stock transaction. So the value of the transaction would depend on when you valued the stock. I mean, in today's term, it would probably be nearly $400 million. But at that time, there was cash and stock component, which would have ended up, I think, based on the IPO prices, somewhere around $36-38 million, because we went public right after the acquisition. So that was the transaction at that time. Journey for that business has been fantastic. When we exited from that business, when I exited from that business, the team, many of the senior people in the team who run that business were part of the team at that time as well. The business was about 26 million in revenue in the year that I left. And then subsequently, now it's gotten to about 700 plus in revenue. So that's a tremendous growth over this period of time, 30x. And it's very gratifying to know that something that you built from scratch has had a good place where it merged with and has been able to grow and become a very successful and a meaningful company.
Fair, man. But the idea that gets to is that 30, 40, or $400 million in today's terms, whatever value you put it at, that's life-changing money. You don't really need, at least I can't envision anyone needing more money than that to live a good life. So that's what, I'm trying to understand here, that was 20 years ago. And you have been working for the last 20 years, and ST is one of the things that you are doing. You also wrote a book. How do you keep yourself motivated to do all of this work when one of the key things that people get in terms of work is they do the work, they get money to compensate for it. But if money is not a motivator, what's actually motivating you to do all of this even today?
Two things to understand here. First, when does money stop being a motivator? I grew up in a very comfortable middle class professional family. My father was a professor and a doctor. He taught in medical colleges. And that comes with a certain kind of lifestyle expectations and expenses. And if I were to stay at that level of consumption, very early on, I had enough money that I could sustain that lifestyle for the rest of my life. Now, of course, people recalibrate. When you start getting money, your expenses start going up. If you were comfortable moving around in a Maruti, now you want a BMW or a Mercedes or a Rolls Royce or whatever it is, it's endless. So if you keep recalibrating, you're never going to have enough. And fortunately for me, my mindset always has been anchored with where I grew up. So I'm very happy living in a way that if I were to live in that way in which I grew up, I'd be still very happy. So for me, that stopped being the reason for working fairly early on in my career. But as the famous psychologist Maslow had written, there is a hierarchy of needs that motivate people. So your first hierarchy is safety. Once you've met your basic needs of food, shelter, you've gotten all of that done. What next? Then is material comfort. So, you get some luxuries. Okay, how many watches are you going to buy? How expensive of a car you're going to drive? So you get all of that done out of your system. Then comes relationships. So are you relevant? Do people care for you? Are you able to interact and connect with people? That still motivates me. So people that I work with day to day, I've got to enjoy interacting with them. I've got to enjoy working on things that I'm working on, and they are relevant to lots of people. And that's, by the way, why I've written a book. Because in the world of quant investment, a lot of people are very secretive. They do their work, they keep whatever they understand and learn to themselves and only use it to generate more money. I have found that actually understanding that and making it relevant to a large number of people gives more meaning to my work. So when I take it and I put it in a sense of how could it be relevant to my sister or my mother's investment portfolio, what can I do for them? It makes my relationships better. It makes my relevance to a broader community much more by doing that. So that's what motivates me. And ultimately, the most important motivator is what's called self-actualization. You try to be the best version of a person you can be. And that's what should motivate you every day. Everything else starts falling away. But that's kind of going in the realm of meditation, and what really motivates you is your own dharma, your own activity, and trying to do things which will make you a better version of yourself every day.
If only I had that amount of clarity, I would probably be figuring out what to do. Or maybe this podcast is the thing which brings that relevance and connection. And I'll be honest, it has helped me personally to connect with a lot of people, which probably I wouldn't have otherwise. So,
That gives its own joy, right? When you connect
yeah,
with someone
it is.
and you help someone, or you are through your podcast, you're connecting with so many people and giving them clarity, giving them some meaning, some entertainment. All of that is very meaningful work.
I hope so. My mom doesn't agree, but I hope someday she does. So, moving on to, so currently you are the chairman of ST Capital. That's ESTEE. I assume this comes from SNT of Sandeep and Tyagi. I believe SR was also fairly similar there. So I understood the name part. I went to the website. I didn't understand what it does. As a matter of fact, if you go to the website, you'll get some sort of a warning that we don't want to share too much information. It's a warning of sorts which pops up, which was a little scary. It's not a very welcoming thing. So, first thing that I want to understand is what is it that ST Capital does?
Well, first a comment on the name. ST, you are right, is from my initial Sandeep Tyagi. It's a combination of hubris and modesty. Hubris because I wanted to name the company after my initials, and modesty, I didn't want to make it totally apparent. I didn't want to just call it Tyagi Sons or something like that. So it's a combination of those two motivations. The second thing, and what does ST Capital do? The way to understand it is we make access and investments easy using quantitative and computer science. So we do a couple of different things. We provide brokerage service in India, and we allow people who want to trade using computers to access the market in the most efficient way. Now, there are people who obviously open up their phone application of some app and say I want to buy 100 shares of Reliance or whatever it is that they're trying to do. But that's not how a large number of people, especially institutions, trade. The way they trade is they have computers connected into the exchange, and the orders get generated through a computer directly to the exchange. That's called, in some words, DMA, direct market access, or HFT, high frequency trading. All of that is computer based trading and connecting directly to the exchange. When we started in 2008, SEBI had just made it legal in India to do that. Before that, it was not legal in India to send an order from a computer. Every single order had to be punched in by a human being. And what people used to do was they would put a paperweight on the keyboard enter key. So an order would come, but instead of a human being pressing the enter key, because there was a paperweight on the enter key, it would still go automatically. So people had found loopholes to make it happen, but it became legal in 2008, according to SEBI, to connect a computer to an exchange and send orders directly. So that's one thing we do. The second thing is, how do you decide what to buy or what to sell? Now, of course, people do it by understanding of their market. They have experience, they study, they understand, and decide individually whether this is a good investment or not. That's not what we do. What we do is we build algorithms and quantitative research methods by which we can digest thousands of parameters about every single security, every single company, option, future. And then using those quantitative algorithms, we decide whether we want to buy or sell at a given time. So there is no human intervention at all. Humans build the algorithms, but when they trade, they are completely autonomous. So we turn them on and they look at all the data that's coming in. They have digested all the data that's available at the beginning of the day, and they decide what they want to do. They, being the algorithms, decide what they want to buy, what they want to sell, and send the order automatically through our computer systems. So we do investment management where we take money from investors to invest on their behalf. We invest using these algorithms. We also provide brokerage services where we allow people to access the market in the most efficient way. And in both these things, we were fairly early adopters of these technologies in the Indian context. It's becoming more and more popular now, but that's what the original vision was, because my background is in computer science, it's in mathematics. So that's what I've been creating and visualizing would be the way to invest and trade.
Fair. So I'd like to maybe perhaps understand a little bit more about this. The first part that you talked about, where you're providing people access to the market for high frequency trading and stuff. So in this case, your typical client or your typical audience would be what? An institution, a day trader, or a 40-year-old sitting at home? What does the typical audience look like?
Typical audience would look like a institution, a proprietary trading firm, or maybe even a small team of traders who have come together to trade like this. It's in the current form not really something which is very suitable for a solo trader, a 40-year-old sitting in their home trying to trade, because it requires a lot of technical savvy and investment to build systems which can trade like this. Now, we are building a product we call S Trade, which would allow you to do all of this trading with just point and click screens. But today, if you wanted to trade like this in a fully automated, high frequency way, you'd have to learn Linux, C++ coding, develop a lot of infrastructure, understand some arcane, complex APIs and how to connect with various things. And then you're going to be able to do it. So generally, it takes more than a single person, lot of knowledge about technology to build these systems. So typically not done by individuals, but by companies or at least small groups of traders.
Fair. And let's say if someone wants to use your services in the second part of it, where you talked about you manage other people's money, how can they use your services? What are the services that are being provided over there?
We provide a range of access options. So we have for foreign investors, FPI based in Mauritius and also US. We are a registered investment advisor. So they can access our products through these funds or our advisory services. In India, we are a registered PMS and an AIF operator. So we have been running PMS strategies for 16 years, and that requires a minimum investment of 50 lakh or 1 crore for AIF. We've also become a investment advisor and a research analyst in India, which means that we can help people invest at smaller amounts as well. So we have nearly 20,000 investors, and the average investor there in the research analyst part of it have average investment of 3 lakh rupees. So pretty much anyone, depending on what is the quantum of investment you want to do, you can connect with us, and we can help you in different levels of providing services and advice. In the research analyst, we provide our research and give you a model portfolio where you can invest, but you have to do your own execution. You have to figure out how to buy or sell using your own brokerage account. In PMS and AIF services, we do the execution. So we just take all your responsibility of managing, monitoring, trading, doing all of that through our systems. And then same thing for the FPI or the international products, where we do the execution and monitor it ourselves.
Fair. So in the PMS or the AIF, when you're talking about investing, you are investing only in the Indian equity markets, the listed space, or are there startups involved or international equity or gold? What all asset classes would your PMS invest in?
The PMS specifically focuses on Indian securities, public securities. We don't do any unlisted securities or illiquid investments. Again, the sandbox for us is the trade decision has to be made using an algorithm, and execution has to be done using a computer. So in today's world, we cannot, for example, invest in real estate because that is negotiated. You have to physically go and see it. That information is not available online on a quantitative basis. And the trade cannot be executed using a computer. Somebody has to go fill out stamp papers, do all of that. So we only focus on investments where decision is fully electronic and execution is fully computer based. Now, we don't just invest in India. We do have products which invest in Brazil. We have products which invest in US. We also work with several other emerging markets where we are doing research and building out products. So we want to build out a global platform. We started with India. We've expanded to Brazil, Singapore, Dubai, Hong Kong, and we want to continue building out ability to invest in several different markets.
Fair. So, but when you are talking about investing in these various markets, there would probably be some sort of restrictions about how much money can be invested and stuff. Because what I know is I have used mutual funds for investing in S&P 500 or the Nasdaq 100, for example. Around a year or so ago, or maybe a little bit more, the government said, no boss, no longer allowed, you cannot do that. And it stopped then. So let's say if, for example, if I come to you and say, I want to invest outside India, where my primary thing is it should not be very strongly related to the Indian markets. Some sort of a diversification objective should be there. And because it is equity, there is a long-term growth perspective which is there. So which service would I use from you? Would I use your PMS? Would I use your AIF? How can I take my investment abroad, so to say?
Yeah, it'll be the advisory service. So LRS, which is $250,000 per person, is allowed from India to be invested abroad. It has restrictions around it cannot be invested in certain types of investment, but it can be invested in mutual funds and securities abroad. So if you wanted to do that and you wanted somebody to guide you, then our advisory service can help you build that kind of a portfolio. If you wanted to invest in a specific product or type of strategy that we run, then obviously you can invest it in directly. So both those things can be done. I think restriction from India through mutual funds is because I think there is a $7 billion limit that the government of India has put to say this is how much Indian mutual funds can invest abroad. And I think that got hit as people were investing quite a bit in there. It'll get increased or it'll open up as well. So I think we've got to keep watching because ultimately Indian investors would be served better by diversifying their equity investments beyond India. Now, of course, there is a nation building aspect of it and saying our capital should be used for growth of our companies and our countries, which is fine. That's one objective. But when you think about an investor's financial needs, then they're better off by at least having some exposure to markets outside India because then they're diversified away from the country risk, they're diversified away from the currency risk. Rupee has depreciated quite a bit. So if you were dollar exposed or you had exposure to companies which have had tremendous growth in the last decade, the FANG companies, Facebook, Amazon, Google, Netflix, that wouldn't be possible if you were only investing in India. So there are good reasons to do that. And I think a long-term investment strategy should be looking at investment opportunities more globally.
Primarily, so it would be right for me to say that primarily the products that your company advises on and sells on is the equity markets. So what's your outlook for the equity markets in, let's say, 2025?
Well, we, as I mentioned, are quant traders, so there is nobody who forms an opinion. So whatever opinion I express is what I would call, dinner cocktail conversation. Everybody is an expert, but I am no better than anybody else in making these predictions about where the markets would go. We use quantitative methods where we digest thousands of parameters to decide what we are going to buy or sell. We do make trades based on data to trade for more than a year, but it incorporates so many factors like what's happening on macro level in gold price, energy price, interest rates, inflation, what's happening in individual securities. Very difficult for me to articulate in 2 minutes. What do I think about
Fair.
market
Fair.
directions?
So let me ask the question slightly differently then. Uh, how should someone even go about equity investing? Let's say I'm someone in the 40s. I know that I need to put in money into the equity markets. How should I start thinking about it? What all should I consider?
Sure. So there are some basic things that everybody needs to understand, especially your audience, which are trying to be financially independent and retire early. You have the first thing to understand is long term, if you want to build wealth, you have a significant advantage if you invest in equity markets. Why? Because in aggregate, the equity markets produce, in a growing economy like India, they are going to produce at least, say, 12 to 15%. Let's say 15% is something you can expect. Fixed income, on the other hand, is not going to give you more than 7 8%. So you have a delta of 7%, which means every 10 years your money doubles from what you would have done if you were just doing fixed income investment. Which means for an average person who's investing over 40 years of their working life, let's say, that means your money is going to be 16 times if you were to invest in equities versus fixed income. That's the multiplier, that's the wealth creator that you have to tap into if you want to be financially independent. The second thing is a lot of people talk about investing at the right time. Now, in the book, which you had mentioned earlier, I talk about how much of a difference would it make if I were to invest at exactly the right time every month. Let's say I was able to invest at the low point of every month versus I was unlucky and I was able to invest only at the high point of every month. Turns out it's not that big a difference because the much bigger trend is what happens over the months, over the years, not what is the low point, what's the high point. So, the best thing you can do is do a systematic investment plan. When your savings are available, invest them. Invest them in a way that is appropriate for your risk tolerance, for your aptitude, for your financial situation. If you have some near term goals or you can't handle a lot of volatility, markets are down 10 15%. And I regularly see now reels where people are crying or they're saying, 35 lakh ka investment tha, 36 lakh ka loss ho gaya. People get really emotional about their investment losses. Unfortunately, emotions and markets don't mix well. They're there in abundance, but they don't mix well. So if you keep your discipline, markets can go down 20, 30. They've also gone down almost 40% as well. They can do that. This is not new information. When you invest in equity markets, you are going to go through that roller coaster of up and down. But because the economies are growing, because the companies are growing over long periods of time, you will do fine. As much of volatility as you can absorb, that much you should invest in stock market and stay there, because then you don't have to pay capital gains tax. Everything compounds much more beautifully and you gain a lot more by investing systematically and staying in the market than trying to time the market. Today, the PE of large cap is about 21, 22. That's expensive, but not that expensive. The PE for small cap is maybe near 40. That is a problem. So you have some small caps that have become very, very expensive. They've gotten way ahead of themselves. Now, can some of them generate enough returns? They can grow their top line and bottom line at 40, 50, 60%. If they can, yeah, it is justified to have that PE, but not everyone will do that. And there will be a lot of blood on the streets as these things correct and become more normalized.
So what happens is, I'll tell you a very realistic problem that happens with someone like me is I'm fairly clear that I want to maintain a 70-30 sort of a portfolio for myself. The only logic being I read in a few places that it is not horrible. That's all that I know. It will not do very badly over a long period. But what happens is in that 70, the equity part of it, I keep reading, oh no, so this is the time that maybe you should be heavily in banking stocks, or, maybe this is the time you should be in large caps and stuff like that. Sectoral bets, to be really honest, I've never had the guts to take. When I started investing, bulk of my investments were in large cap funds and large cap stocks, because people said that you take the Nifty and that's the safest way to get into the stock markets. But over a few years, now I have small cap funds and mid cap funds in my portfolio as well, because it's not something which is constructed over a day. It's 20 years of savings which are there. So I'm fairly clear about the fact that I need to maintain that 70-30 ratio. Should I be switching in this particular part? Say, for example, as you're saying right now, that probably large caps are not that expensive and small caps are in a slightly weaker space, if I can call it that. So should I be just switching money out from small caps to large caps, or, how do I decide when to keep what? And if I keep all this switching, there will be capital gain taxes which will come in. So how do I decide when should I take action and when I should not take action and just let it be?
So, a lot of people believe the model portfolio 70-30 or 60-40 is what they should hold. I think that's a little bit of a misnomer. For people who are younger and still have a lot of productive working life and savings ahead of them, especially people who are much younger, don't have a lot of responsibilities. They don't have to educate their children or buy a house or do other things at this stage. For them, having a higher exposure to equity will turn out better. However, again, your aptitude is important. If you can't handle the volatility, then it's better to do 70-30. That's a good thing. But that's what should determine how much you should be in equities versus fixed income. Now, as it pertains to timing, by moving and chasing performance, inefficient both from execution, you pay costs in buying and selling. It's inefficient from taxation. 1.5% of impact just comes if you were to buy and sell every year versus keep on holding long-term capital gains. Even then, per year, you will lose about 1.5% or so, just because you're going to have to keep paying capital gains tax every year versus waiting for 10 years. All the money you make on the tax you would have paid comes to you. Because if you pay tax every year, that money is going out of your pocket. So my suggestion to people is build an asset allocation that you're comfortable with. Let's say that asset allocation is 50% I'm going to be in large cap, 20% I'm going to be in small cap, 30% I'm going to be in fixed income. Let's say that's what it is, roughly based on what you have told me. Now, if this year you can see the data that small case has become overvalued, large caps are reasonable still. Whatever additional money you're putting in, put all in large cap. That's okay. But do not change things too much year to year. Very seldom will you find that the markets are so mispriced that what I call a weekend investor can just look at something on YouTube or on Insta or something like that and form an informed enough opinion on where to move their money in all these sectors. This is flavor of the month investing. You hear about something, oh, Bharat is going to be great investment because rural India is growing, or defense stocks are great, or momentum investing is great. All of these themes, they have their strengths and they work. Momentum is great. It is proven as a factor that will produce a little bit of an extra return, but it is more volatile than overall diversified investments. So if you look at momentum investors in the last 1 year, they are down a lot. And the reason for that is market has turned.
Momentum works both ways, going up as well as
And
going down.
so there is no free lunch. If you want to get higher potential returns, you have to take higher risk. And you can choose to take that higher risk By saying, look, I'm going to invest more in mid caps, more in small caps. That's higher risk. Now, once you do that asset allocation, you stick with it. And you do tactical allocations by taking additional money and putting it in one place or the other. So it starts moving in that direction. That's a much better strategy than moving lock, stock, and barrel from small caps to large cap and then back and then, not a good idea.
Fair, fair. Sir, the biggest problem in doing what you are saying is there should be additional money coming in. Podcasters don't make that much money to have additional money coming in. But I think I
Yeah,
understand
but then
the
that's tactical
construct.
allocation. So you
Yeah,
adjust on the margin. You maybe take 5
margin.
10% of that and you put it there. That's what's called tactical allocation. So you have your overall allocation of what you want to do. And then on top of it, maybe a minority, small piece, 5 10%, you move from one to the other place.
So, which brings me to the next question as to we talked about how people should be managing their money. How do you invest your money?
Well, I have two or three different buckets. I have my large part of my money and net worth is invested in private companies, my own. I'm a significant owner in this company, so a big part of my net worth is invested there. I've made certain private equity investment, angel investments, because I like to be associated with new idea creation, whether it is in machine learning or new types of analytical solutions, things that I know about. So that would be a second category. Then I've taken portfolio bets to fund certain types of needs. There are three big needs that I've focused on. One is my retirement, second is my children's education. Now they are 25 and 23 and almost done, but I planned for it 20 years ago. And third is my own health account because in United States, towards the later parts of the year, the health expenses become very, very high. So you have to actually save for that systematically, which I'm doing. I put it all together. It's entirely in equities. I do not put anything in fixed income because I've saved enough for what those goals are, and now I'm trying to simply grow that. So my allocation in my savings allocation would be very little to fixed income in these parts. I do have roughly 15-16% of my overall net worth in fixed income type return, which I keep there as a safety cushion for myself because I don't want everything going up and down every year. And I know at least that much is going to be available to me, even if there is a dramatic or drastic event that happens. So that's how I managed my portfolio. Less than 20% in fixed income is about 16%. There is a specific portfolio which meets these three needs that I articulated, and everything else is really maximizing by building in new companies, investments, things like that.
Can you tell me a little bit more about the angel investing space? I know that you have invested in stable money. I met those guys last month. But is there a specific type of companies you are investing in, or
Yeah.
I want? How do I approach you? What sort of idea should I approach you with?
I'm not a VC. I'm not a prolific angel investor, as a lot of people have invested in hundreds of companies. I invest in people who I've already known for many years. I have some history with them. So, Stable Money, one of the co founders, Harish Reddy, was my colleague in ST. I've invested in Doclens.ai, which is a startup focusing on using artificial intelligence for insurance in US. Arnab Dey, who's the founder, co-founder, CEO, is my colleague from Inductus days. I've invested in Spectramedics. I've invested in Extria, where Jassi Chadha, who's the founder, CEO, was my class fellow and roommate long time ago. So I invest in companies where I know the people well. And the second thing I do is I invest in companies which have something to do with analytics and computer science, because those are two things I understand well. And therefore, I can not only understand the business, but I am of some use or value to the founder and the CEO if they want to bounce off something, if they want to get my opinion, I would have an informed opinion about what they're trying to do. So that's kind of what I focus on. I'm not really a very active angel investor that people could reach out and say, here is a business plan, would you invest? That's not something I
Fair.
have the
So
capability or time to do.
yeah, so probably a better idea would be to look up the people who are working at ST, ask them to become a co-founder, and then approach you. I'll ping Vivek as soon as I hang up this call and try and work out
That
something.
always works. I'm always happy for people to become entrepreneurs and take because I think that's a very for the right person who has that aptitude, because it's a volatile journey, but it is very gratifying for the right type of person.
So when you talked about your investment, you said around 16% is in the fixed income space. There is this private equity. I don't really know how can you even value what your stake in stable money is worth at this point of time. But about the other part, so you are saying that there is no significant real estate investment that you have, no gold in the portfolio, no crypto bets or are, so other than the fixed income and obviously bulk is equity, do you have exposure to other assets like gold, real estate, crypto, or some other stuff?
Been there, done that, lost money and came back. So we built a systematic investment plan into crypto. When we did it, which was about 3 4 years ago, it was still a very very nascent. I believe it's much more stable, but still nascent ecosystem. Now that there are institutional bodies like BlackRock and others involved in it, which have put in a significant amount of money in there, it's probably a little better, especially Bitcoin. Tons of other crypto coins, I think, are too early and too risky to bet. Very speculative. Gold and real estate are, as an investment, they have a couple of issues. One, they are either concentrated, basically single asset risk, and illiquid, particularly real estate. You buy a house or something, you have one location. If a highway goes next to it, or the market around that starts growing rapidly and becomes very crowded, the value of your investment will go down, but you can't do much about it. It's not like you can take 10% out and say, I'm going to diversify here. So concentration risk, illiquidity risk is there. Both these investments, gold and real estate, over 50 years will produce just over fixed income return or about the fixed income return. They're not going to produce much more than that. Of course, you will hear stories. Somebody will buy an apartment and 2 years later it's double the money. But in aggregate, that's what return these things produce. So why invest in them? One reason to invest in them is taxation. Fixed income, every year you have to pay tax, and it is now generally taxed at a marginal tax rate. So you're going to pay 30% of whatever you earn into that. If you invest in real estate and in gold, you don't have to sell it. If you don't have to sell it, you don't pay any taxes. So you compound your money in a better way because you're not paying taxes along the way. Even though the overall return is going to be the same, then you will come out ahead compared to fixed income if you put and hold money in these asset classes. The problem is people chase performance. So they hear gold has gone up a lot, they'll get into gold. Then they'll hear, oh, this apartment is coming, they'll sell the gold, get into real estate. Then they'll see, oh, it is, become 50% up, they'll try to sell it and get into third thing. That is not a great way to invest. Again, create an asset allocation. If your asset allocation was 30% fixed income and you knew that you're not likely to use, let's say, 20% of it, it's okay. If you wanted to use that money for tax purposes and long-term holding into one of the gold or real estate asset classes, that's fine. Now, of course, I'm taking out whatever you need for your personal consumption. You and your wife, I don't know if you're married or not, but your family wants to live in a beautiful house. Absolutely. That's why you're earning money. Buy a real estate, live in it, enjoy it. You want to have a nice piece of jewelry? Great, do that. But if you're doing that because you're trying to save for the future, then these considerations apply, which I just went through.
Fair. So I think, Sandeep, that will really, really help me as well as my listeners come up with some sort of a framework that works for them. And that has been my key goal with this podcast. I do believe with your book, you also talk about some of the investing lessons which people can use. Is your book for a layman, or you need to have, let's say, at least a basic understanding of how to evaluate a company, or who can actually pick up your book? Can you tell us a little bit more about that?
Yes. So the genesis of the book, as I mentioned, was coming from the somewhat secretive world of HFT trading and quant trading. I find that many of my colleagues and peers in other companies, and even my own company, they want to protect all the knowledge that we are getting and understanding we are getting completely secret, because we, of course, feel like if we have the secret of how to make money, you don't want to share very broadly. But there are plenty of learnings which over time I have gathered. And when I talk to even my own family members, my nephew or my son or my sister, my brother in law, I found that their understanding of how to make these investments and how to grow their savings nest at some points taking them exactly in the wrong direction. For example, trying to chase performance, trying to time markets, trying to be very, very conservative. Some of my relatives are all in fixed income and they believe, oh, this market is not for us. We don't want to put anything because it's a very dangerous place. These are just not right ways to think about your wealth. So I came up with this book. The way it is written is actually fairly simple and basic and straightforward. Effort I put is in making it broad. So I've covered the whole journey of investment, but I haven't made it very deep. It's only 174 pages. I could have written the book in half the size, but my publisher told me nobody's going to buy an 80-page book. So I've added some more stories, I've added some sections where I go deeper in it. But in reality, if you read the first one third of the book, you will understand everything you need to know to invest properly. And that was the goal, that you get a very simple do it yourself guide. You understand what you need to know about investments, and you get enough data to be convinced that what I'm saying is backed by information. It's not just opinion. There are lots of talking heads who will just give you gyan, but it's not backed by facts. So in my book, I've tried to put in a whole bunch of data, facts, charts, graphs for people who need that. If you look at it and you trust it and you follow it, don't need to go into the data. But if you don't, and you need evidence, then there is enough evidence I've presented in there with real data, charts, and tables that you should be able to validate it for yourself that the things I'm saying make sense.
There used to be that Soviet Russian proverb at that point of time with the KGB used to use that trust but verify. So if you want to trust, that option is there in the book, but if you want the data backing, that's there as well. So to Sandeep, really, I'd like to thank you for taking out time and coming to the show and explaining your investment philosophy, among other things. To our listeners, I have ordered Sandeep's book today, and I should hopefully get it in a day or two. As soon as I get the book, I promise to post a book review. I will also suggest that you guys can check it out at Amazon. It's called The Little Book of Big Gains, a guide to investing wisely. And currently it's selling for 237 rupees over there. So please do check it out. And thank you, Sandeep, once again. Thanks for coming to the show. And listeners, please remember, I always forget that. And that's why my thank yous and goodbyes are so long that I forget to say that please like the video, comment on the video, and subscribe to our channel. Thank you.
Thank you so much, Ravi. Thank you, everyone. Wonderful to see you. Please feel free to connect with me on Instagram or LinkedIn. And very happy to answer questions for people if you have anything on the podcast or the book or even in general about investment or finance. I am generally active on LinkedIn and Instagram. Thank you so much.